All right, let's dive into a really fascinating corner of the financial world, alternative investments. If you've ever felt like your portfolio is just on a roller coaster, completely tied to the whims of the stock market, then this is for you. We're going to break down what these investments are, why the pros are so into them, and how they fit into the big picture, all based on the core curriculum for investment professionals. So let's get right to it. So let's just start with this one powerful question. What if your investments didn't have to follow the herd? I mean, really, what if you could find opportunities to grow your wealth that aren't just hitched to the daily ups and downs of the S&P 500? That's the whole idea behind alternative investments. And honestly, it has completely changed the game for building a modern portfolio. Okay, so let's get beyond the usual suspects, stocks and bonds. To really get what alternative investments are, we actually have to start with what they aren't. And believe me, that distinction is everything. Here's probably the easiest way to think about it. Traditional investments, those are the names you know, right? Stocks, bonds, cash. They're easy to access, everyone talks about them. Alternatives are, well, everything else. And because they're in that everything else bucket, they tend to have fewer regulations. Now, that gives them a ton of flexibility, but it also means they're a lot more complex. It's a classic trade off more freedom, but you've got to do your homework. Now, I know everything else might sound a little bit chaotic, but in the world of professional investing, it's actually pretty organized. It's broken down into four major categories. So let's take a look at what they are, and you'll see just how huge this space has become. And I mean, the scale is just immense. Take a look at this breakdown from 2022. Private equity is the undisputed king of the hill, grabbing almost half of the entire pie. A big reason for that is just this relentless search for higher returns. But as you can see, hedge funds, real assets, and private debt are all massive players in their own right. Let's break each of these down. First up, we have real assets. The keyword here is tangible. These are things you can, theoretically touch and own directly. We're talking about physical stuff, non-financial assets. It could be an airport, a plot of farmland, a forest of timber, or even something like the patent for a new technology or the copyright to a hit song. Next up, hedge funds. Think of these as the nimble, opportunistic players of the investment world. Because they have minimal regulation, they have this powerful toolkit that's pretty much off limits to your average mutual fund. They can short sell, which is betting against a stock. They can use leverage, that's borrowed money, to magnify their bets. All of this lets them hunt for very specific and often very complex opportunities in the market. And then we have the giant, private equity. At its heart, this is all about owning a piece of a company that isn't traded on a public stock exchange. This could be early stage venture capital, funding the next big thing. Or it could be a massive leveraged buyout, where a fund uses a ton of debt to buy a public company and take it private, with the goal of fixing it up and selling it later for a big profit. And finally, there's private debt. You can basically think of this as the entire world of lending that happens outside of the traditional banking system. You've got specialized funds that lend money directly to companies, or they might even buy the debt of companies that are struggling, betting that they can make a comeback. It's a huge and absolutely crucial part of our financial system today. Now, all these strategies might sound pretty new and cutting edge, but they're really just the latest step in a long, long evolution. To really get why they're so dominant today, it really helps to see how the whole game of institutional investing has changed over the past 100 years or so. For the longest time, the goal was super simple safety, just don't lose the money. Then along came modern portfolio theory, which was a light bulb moment. It taught us about the incredible power of diversification. But the real game changer? That came in the 80s. Institutions figured out that if they added assets with low correlation to stocks, meaning stuff that zigs when the market sags, they could dramatically smooth out their returns and lower their risk. And that, right there, was the birth of the modern era of alternative investing. So, what is the secret sauce here? What really gives these alternative investments their edge? Well, it all comes down to a few core characteristics that just make them fundamentally different. A huge one is illiquidity. I mean, think about it. You can't just sell an office building or your stake in a startup with the click of a button. So, because your money is tied up, sometimes for years, you demand a higher potential return to compensate you for that inconvenience. This illiquidity premium is a source of return you just don't find in the public markets.
Next up is what we call market inefficiency. In the public stock market, information spreads like wildfire. It's really hard to have an edge, but alternative markets, they can be much more private, more opaque. And this is where it gets fun. It creates these pockets of opportunity for really skilled managers to find hidden gems and generate alpha. And alpha is just a fancy word for returns that come from skill, not just from riding the market. And this leads us to the idea of absolute return. See, a traditional fund manager might lose 10% in a year, where the market lost 15%, and they'd call that a win. They beat the benchmark. But an absolute return manager, they're only happy with one thing, a positive number. The goal is to make money, period, no matter what the rest of the market is doing. So when you put all of these unique pieces together, you get this incredibly powerful toolkit. Investors use alternatives to hit these 5 key goals. It's not just about chasing bigger returns. It's about building a smarter, more resilient portfolio. It's about diversifying risk, making money even when the market is down, and getting in on opportunities you just can't find anywhere else. So, with all this complexity, how do the professionals actually decide what makes sense? How do they analyze these things? Well, their whole process really rests on 2 fundamental pillars of thinking. Think of it like a 2-part test that every idea has to pass. First, there's empirical analysis. You look at the historical data. What does the past tell us? What's worked before? But that's just looking in the rearview mirror, right? So you absolutely have to have this second part, economic reasoning. This is the common sense check. Is there a logical, sound economic reason why this strategy should continue to work in the future? You need both. You can't have one without the other. Okay, so how do you organize this whole complicated universe in your head? There's actually a beautifully simple but really powerful framework that can help. It basically classifies everything by asking just 2 key questions. And here it is. Let's just walk through this. On the vertical axis, you have the main goal. Are you trying to diversify and manage risk, or are you trying to enhance your returns to get that alpha? Then on the horizontal axis, it's about how it trades. Is it public or private? And just like that, everything has a home. You can see a hedge fund, which is all about generating alpha in the public markets, fits right here. A real asset, which is privately owned and amazing for diversification, goes over here. It is just a brilliant way to map out the entire landscape. And all of this brings us to what's next, the future. Because the world of investing never, ever stands still. And those clear lines we just drew between traditional and alternative, well, they're starting to get really, really blurry. See, for a long, long time, this was a world that was pretty much reserved for the big institutions, the endowments, the pension funds. But that is changing, and it's changing fast. Financial innovation is now taking these complex strategies and packaging them into products like liquid alts or REITs, things that everyday investors can access. And that is blurring the very definition of what's traditional versus what's alternative. And that leaves us with one last really fascinating question to think about. As all of these powerful, complex strategies become more mainstream and more accessible to everyone, what is the word alternative even going to mean in 10 years? Will it just become, well, investing? That is the big question that's going to shape the next frontier of finance. Thanks for tuning in.